more of a qualitative thing, something that's more, a model-driven strategy than a fundamental strategy. It's just trying to figure out, you know, it's just been in my career, the simpler the strategy, the simpler the model, typically the
Yeah.
better.
Welcome to The Derivative by RCM Alternatives. Send it.
Hi, my name's Tom Holliday, founder and CIO of HIP Investments. I'm here to talk about all things commodities on the derivative.
How are you, Tom? Thanks for coming on.
Thanks for having me.
You
Great to be
look
here.
you look like you're in Tennessee or Illinois. Where usually we'd say Norway or Alaska, but the
I'm in
Northern
space
Lights.
somewhere right now.
Or right, was that last week or 2 weeks ago? The Northern Lights stretched all the way down into the middle states there, which was exciting. My
Yeah.
daughter went out to Lake Michigan here and was sending all these pictures, and I was up in a building, and I'm like looking out. I'm like, what are you talking about? She's like, oh, it only works if you use this filter on your phone. You can't actually see it with your eye. And I'm like, well, then did you actually see it? So we had this whole debate of like whether
If a
it
tree
actually happened
falls in
or
the
not.
forest and no one hears it, did it actually fall, right?
Exactly. So wanted to have you come on. We were chatting at a conference and share a lot of similar ideas on commodities and multi-strats and all that good stuff. But let's start it out with a little background. You know some of the old stalwarts in the commodity space as well.
Yeah, I do. So I started my career in commodities in Tennessee and was at Refco and Refco office in Memphis was associated with Sparks Commodities with the famous and notable Willard Sparks who had a very storied career in the commodity markets and did some really cool things with Cook Industries in Memphis before he started Sparks Companies and then became an owner of Refco.
Willard Sparks. And what was he like? I don't think I ever got the pleasure to meet him. Larger than life. Like I've known many people tell me about him, but give us the background quick.
Yeah, I think he was larger than life, but he was also genuine. He's an Oklahoma cowboy that got his PhD in agricultural economics and did a big thing, which was the first grain sale to Russia in the early 70s, and um, was just really 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 smart. Loved research, loved the ag markets, and like I said, very approachable. So it was a unique place to work.
Yeah. And then Revco's another blast for the past. So um
Blast
Revco,
from the past.
right. Were
Yeah.
you out of there before MF Global took
Oh
over and all
yeah.
that jazz? Yeah.
Yeah, I left in 96, but listen, Refco was an amazing place as well. It was a very entrepreneurial firm. Allowed people to do some really creative things. They became the world's largest futures commission merchant. I guess there's nobody can actually claim that, but it was rumored
Yeah.
that they were the world's largest FCM. And unfortunately, like a lot of firms, got into trouble in 07, 08 around rehypothecating securities and some other things that unfortunately took them down. But what a terrific firm! What a cast of characters that came out of that place over the years. That I still bump into a lot of them today. It's kind of crazy.
I think if you go on NFA, I think I was actually registered for like 2 months as a Revco broker before I started my own firm, Attain. But
Do you know the secret handshake and everything?
I don't know the secret handshake. And then tell it. So you grew up in Memphis
I grew up in Memphis.
and then so I don't think most people know, right? Like Memphis is a true commodity hub, mostly cotton, but like tell us the commodity connection with Memphis.
Well, yeah, I think it's largely the Mississippi River and the cotton market to really be the two. Mississippi River being the main transportation system to take grains all the way down to the Gulf Coast for export. And then obviously the Cotton Exchange of Memphis, which is was the world's largest cash cotton hub, and all the characters that kind of came out of that with Donovan Enterprises for years, and now Joe Nicosia and what he's done for the cotton markets, and
It's
all
Louis Dreyfus.
oh yeah, and then all the other really colorful personalities in the cotton market that came through there. And then, the famous one in the hedge fund side is Paul Jones, who's from Memphis, who started his career trading cotton. Billy Donovan was his uncle.
You know him when you just call him Paul Jones, right? Paul Tudor Jones,
I
PTJ.
call
I
him
don't think,
Tudor.
yeah,
Everybody else calls him Paul. I call him Tudor.
I don't think
Uh,
anyone's called him just Paul Jones in 20 years.
that's true.
Um, but it's always to me, right? Like New York had a cotton exchange. London had cotton, right? So it was like, why did Memphis become such a thing? I guess just the river. But to me, it doesn't seem like it made sense to get all this cotton from, right? Was it coming from the east, going west to the river?
No, so this is a cash cotton exchange where
Yeah.
in New York was a futures market. So in Memphis is obviously the Mississippi Delta, which is where a lot of the cotton was produced at the time, right? Which was up and down the Mississippi River from Louisiana up to the Boot Hill of Arkansas. You know, both sides of the Mississippi rivers where, most of the cotton was produced for years. And then California began producing a ton of cotton. And then obviously West Texas, where they just have, you know, just, unlimited amounts of land that they can plant a bunch of scrubby cotton on. No
No water, but
disrespect,
a lot of
no
land.
disrespect to the Texas cotton guys, but
Yeah.
no, but it can really make or break the crop. Just given if they get water, how much cotton they can make out in West Texas. But going back, because all this cotton was produced in the Mississippi Delta, pre-Civil War and post, it kind of became the cash cotton hub of the
Yeah.
world.
And did you know as like a kid, like, oh, I'm going to get in the futures business, in the commodity business?
Had no earthly idea. So, as a Boy Scout, I remember going to the Cotton Exchange as a little kid, and that's where they still wrote in chalk on the walls, chalk walls, the price of cotton and the different contract months, and it was right there on in downtown Memphis near the Peabody Hotel, which is a very famous hotel. But
With the
and then
ducks.
obviously the movie The Firm, went by the Cotton Exchange building. You saw a big cotton bale, kind of one of the windows he
I think
jumped
he
out.
jumps out, yeah, into the
Yeah, he
cotton bale.
jumps into a big bale of cotton. So that was the cotton exchange was still kind of doing its thing back then. But no, I mean, my dad was a doctor, and I was thinking about becoming a doctor, and I'd heard about Dr. Sparks,
Different
just
kind of
from
doctor. Yeah.
yeah, PhD. Dr. Sparks about from his reputation and some family friends that overlapped and some people that I knew that worked at Refco. And when I decided I didn't want to do the medicine route, I was like, well, this looks pretty interesting. So I started learning a little bit more and talking to some people and decided to make the jump.
And what did that jump look like? So Revco, and then how long before you ended up at the next spot, which was a pretty cool spot.
Yeah, so Refco was for 6 years. Fascinating times. I think futures trading, honestly, is probably one of the best training grounds for markets. And why do I say that? I say that because futures, the contracts themselves have embedded leverage in them, and therefore, from a risk management standpoint, you know, you better have kind of your wits about you as you think about the notional exposure that you have, how you're trying to position a portfolio relative to a view, whether it's directional, whether through spreads, whether through relative value. Um, Futures trading has a strong fundamental component to it, supply demand. Supply demand really drives everything, and understanding how supply demand affects prices of things, and then substitution that comes along the way
Mm.
by this one's too expensive, I can substitute for this, or regional and geographic arbitrages that happen because of that. And then
Tough
so
to
that's
substitute cotton. Yeah,
polyester.
yeah,
So
there you go.
And then as you continue to think about commodities, you have this technical component too, which is, they're traded a lot by CTAs. You have positioning and you have flows and you have all these other things. So fundamentals will get you from A to B over the time frame, but the path can be really, really bumpy, which technicals and positioning and flow can kind of help you with. And as you know, with futures trading, unlike stocks you just buy and hold it forever because there's no expiration of a contract. In future trading, you have a calendar strip where you have expiration of a contract. You have backwardation and contango, which goes into a roll yield or not, and little nuances like this, which make it fascinating from a market's perspective and a great training ground just in terms of risk and fundamentals and positioning, which I think lead then to every other kind of market that's out there and understanding those basic principles and how they apply to really a lot of different markets. So I thought it was a
Right. It's
great
like
training ground for that. And then,
basically if you can trade natural gas futures without getting run over, taken out on a stretcher, you're good. You've learned risk, you've learned markets.
if you
We
understand
can
the Widowmaker, which is March, April, you've kind of got everything else under control. But yeah, but all these markets have different nuances in terms of what are their drivers. In natural gas, it's the injection and withdrawal season and weather. How much does it impact balances along the way? And it can be very acute in very short periods of time. And therefore you gotta really be aware of how it moves those things. When in the grain markets, it's really a lot by the planting season and growing season and what happens to those commodities during the key pollination periods, depending on whatever crop it is, and then the now with Brazil coming on strong and planting everything, it seems like these days in the same crop year, then you got to kind of figure out how balances are affected by those. If you go to something like power and electricity, it's a whole different animal in terms of, you can't store electricity. So you use it or lose it. So
not
then it's
yet.
about
Yeah.
the immediacy of that as well relative to these other commodities. So it's fascinating about all these. They have different return drivers. They have different things that affect them, which make them very non-correlated, which is pretty interesting.
And then did you trade yourself ever? Were you ever trading your own P&L?
Well, everybody does a little bit of
Yeah,
that,
a little bit, but
right?
like
But no,
have you
I didn't trade for anybody else. No, it was just myself.
tell us about Titan?
Yeah, so I left. So I actually got an opportunity to go to work for George Soros Fund Management in April of 2000. So this was right after the tech wreck, which happened in March of 2000. Soros was a little bit was I wouldn't say disarray. Stan had decided he wants to leave the
Mm.
firm, and he was the one running the portfolio. There were a lot of traders inside the firm at that time that actually left as well. So we had four internal traders at Soros at that time. We had a lot of excess capital because all these other traders left. So then
What
we
year is
had
this?
this is 2000.
2000.
So then we had to so then I was
Post the Bank of England.
yeah, Bank of
Yeah,
England was the early 90s. So yeah, so that
94.
was ancient history. Um, but um, but it was really fascinating. I got very, very fortunate where I got to work with George Soros in an investment committee to help allocate capital to some external funds. Um, it
So
was
let me interrupt you for a second. How does that work? How did you just did you was that luck that you just happened to be in the right place at the right time? Was he actively searching someone with the skills you had, or right? But for people listening, like, how can I get such a job somewhere?
I wish I could say it was no, it was all because of me.
Yeah, it was all my Zoom
No, listen,
background.
it's as you know, there's a lot of good fortune in a lot of things we do in life. And I'm a big believer in the harder you work, the luckier you get. You put yourself in position, hopefully, to kind of get noticed. And there was actually a project I did with this other woman I was working with at the time, where they were looking at potentially hiring someone to bring internal that was based in San Francisco, and we did a project for them, and off the back of that project, I was offered a position to come in
Yeah.
internal.
Makes you
Uh,
wonder if it was a real project or it was like they were just putting it out there to see who could, right? Like the solve the chalkboard problem in Goodwill Hunting.
yeah, well, I don't know well, it's kind of weird. Like I said, it's good fortune. You don't really know why these things happen, and I think these things that come up in life, you can look back and say that was an important point, or this was an important point. That was an important point as well. I'd been coming to New York quite a bit before that, and knew a lot of people in the industry, and now getting up there to be with one of the top three funds in the industry, and working with one of the most notable managers in the hedge fund industry was really interesting. So I had a really interesting, brief time there.
Was
When
Jim
I got
Rogers
there,
there at the same time?
huh?
Was Jim Rogers there at the same time?
Nah, he left way earlier.
Okay.
I think he was gone in the 80s. But no, it was a whole collection of different portfolio managers. Scott Besson had just left as well, but he actually came back and was working with the investment committee as we were looking to allocate capital as well. So it was it was a fascinating time, and some of the people that we met are some of the stalwarts in the hedge fund industry today that we put money with. So it was once again it was a fascinating time. But I knew a guy from Nashville who was living in New York, and we began talking about starting a hedge fund of funds. Um, and so I left Soros to help get that going. It's called Titan Advisors. They're still around today.
Mm.
I was co-founder and CIO of that for about 19 years. We launched it in 2021, and I left in 2019. Um,
I bet most people listening to this would take, if you said, are there any fund of funds that lasted over 10 years? Most would probably say no, right? So they're still around
Very
and
competitive
posting.
space. And by the way, we built something really interesting and really unique. We really there were a few fund of funds out there, and a lot of them had money with all the Tiger Cubs. We didn't
Mm.
really have a lot of money with the Tiger Cubs. Not for any particular reason. They were phenomenal, as everyone knows. We liked a little bit more of an active trading approach. The Tiger guys were a little bit more fundamentals. We liked the combination of fundamentals and trading. So we had a lot of money with Steve Cohen and some of the
Mm.
proteges that spun out of SAC Capital then, 0.72 today. Um, we did a lot of more things in the commodity space in our macro bucket. So we were really early to some of the natural gas traders in the early part of the 2000s that had done really well. We'd had some money with some of the other big nodal commodity traders like Michael Farmer at Red Kite Capital, which was a huge
Yeah.
copper trader that did exceptionally well. We had money.
Andoran, do you have any money with him?
We didn't have money with Andron. We met with him when he was a blue gold. We met with him subsequently. We didn't put money there. He was obviously, had an unbelievable reputation as just a, a uh, a fearless trader in the oil markets. We got that exposure to some other people. We had some money with Clive Capital, which is a guy named Christian Levitt who spun out of More Capital, which was phenomenal. He was based in London, and anyway, I could go down memory lane with all the different
Yeah,
guys,
you
but it
got
was
you got a hell of a Rolodex is the
yeah,
end story, right?
yeah, it was well, it was what's interesting about the fund of fund seat, which I don't know if people um, fully appreciate, and I probably didn't as well in terms of looking back. But you know, in my career, we hustled at Titan. So we were really involved in emerging managers and trying to find people that were new, that were just embarking on their career and starting up the funds, who had great reputations coming out of another notable hedge fund or a bank or some prop desk. So we met with a lot of people. So I don't know, I probably met with 3 or 4 thousand hedge funds in my career globally, from Asia to Europe. we would, go on a trip and we'd have, five back-to-back meetings with managers in that area for however long we were there, 3, 4, 5 days. And we were always, on the road trying to meet different fund managers. And you do that for 20 years. And
Wow.
just the breadth, the breadth of the things that you see are pretty interesting. And we looked at things across long-short equity and credit and commodities and macro and event driven and multi-strategy. So you get to see the process that all these people go through, and then you get to see how they manage risk in all these different ways and how they execute. And all that gives you just a huge lens in terms of seeing all those things. And then it presents like a muscle memory. It's like it's no different probably than a private equity or venture capital guy that sees a lot of things. And there's a
Yeah.
muscle
A lot
memory
of
in terms
deals.
of, well, if I hear that and I see that, it triggers a thought that I really want to pull on that thread and learn a lot more. Same thing in this fund management world where, you meet with people and you hear certain things and you start to connect dots and there's a muscle memory where like, this feels pretty interesting. I want to learn a lot more about this person's
What you're doing.
process.
Did you ever, to me, I hear 5,000 meetings and I'd be like, I think I would have lost my politeness around 1,200 or so. Right? Did you sit in
At
meetings be like, all
about
right,
3,000, I started losing my politeness probably a little bit. And there's no disrespect. I
right,
mean,
just like, hey, you can skip those first 10 slides. We've got that. Let's just get to the meat of the thing here.
yeah,
Uh,
and once again, it's the business has changed so much in the last 30 years. And once again, I mean, all these traders and these PMs that we've talked to went to great schools, had, great careers at different places. And unfortunately, those things have become kind of table stakes. You know what I'm saying? You have
yeah.
to have that.
Mm.
Okay, you've got what everybody else has. Now it's how you doing something differently than the person you went to school with because they were trained the same way you are. And this is a competitive space. And alpha is actually a rare term. Not everybody can have it, and there's only so much of it. So how are you going to get it and maintain it and keep it when everybody you went to business school with that's in the same industry is trying to do the exact same thing you are
And
and
it's
capture
zero
it? So then
sum.
it's like so then it's the more nuanced things that are really important in this business about what drives a person. Number one, it's like what do you want to do, and what's your ultimate goal with the fund and the return targets, and who are you trying to please with your returns, and how much of your money do you have, and the other little nuanced things is like managing a lot of people. Do you like managing people? Do you not like managing people? How big do you want to get the team? Do you think you're good at managing? I mean, it's
Mm.
all these little
Yeah.
things kind of come into the soft part of it, and then you get to the hard part of it, which is they're usually excellent at, which is tearing apart balance sheets and income statements and finding opportunities to be on the long-term equity side or on the commodity side. You know, interesting networks with people in the field that help them to understand locally what's going on with producers and when they want to let go of their crop or interesting information in terms of flows of natural gas or demand or production and what little things are they doing just to try to get an incremental edge that then they can turn into a trade they can construct and a duration of the trade to extract that value. So it's all about starting with qualitatively, getting comfortable with the person and what makes them tick, and then going into the process side of tell me these big things. Process, what do you do? And what in that process is maybe the incremental thing that's a little bit different. Number two is portfolio construction. How do you take that idea and then how do you express it the best way? So, is it flat price? Is it options? Is it spreads? Is it RV? Tell me how you think about that and risk as it relates to that. And then you go to risk management. It's like, okay, end of the day, what is your risk management discipline, right? For me, it's live to fight another day. Now, that's pretty fuzzy, but it's
Yeah.
the most important thing out there. What are you going to do to live to fight another day? And let's hopefully have a P&L history where we can go through things. And I like to see poor periods because they're teaching moments, right? What happened? What'd you get wrong? How'd you turn it around to get it right? Was there one certain thing that kind of led to the poor performance? Was it an event? You know, I like to
I got
find people that are good sellers and not just good buyers. Everybody can
mm,
buy. Good selling is hard to find, right? Really, really hard to find. So
I
it's
was
it's a maze of things.
I was gonna share it quick. The an option seller guy we work with, he says it's like being a pilot. He's like, no one, if you flew 9,000 successful flights, 9,999, and you crashed and killed everyone on the 10,000th flight, right? He's like, no one remembers the other nine. Like, you have to get the plane on the ground safely every time. Like,
That's
it doesn't
right.
matter. You can't crash your last time out.
And I
Which
think
is
that's the
somewhat of
key.
like, yeah, just live to fight another day is get the plane on the ground safely.
Yeah. And it's for me, then it's looking at three key risk factors. Um, because I think every strategy has these three and then probably two others. Those three are how much leverage is being used to drive returns? Is there any type of illiquidity? And what is the concentration? The
Mhm.
other two things that could be added are complexity and correlation. Complexity, like if it's a model different strategy, how complex is it? Or if it's something that's depending on a stability of a correlation holding up. Correlation is, it's not a number, it's a pretty bumpy series over time.
It
So
looks
you
like
kind of,
behind you, right? Looks like the graph on your
that's
Zoom
right.
background. Yeah.
Yeah. It's kind of
Nebulous.
fuzzy like that.
Yeah.
But every strategy's got one or three of those. And I don't like leverage and illiquidity because that's usually a game over event at some point. That's when you don't live to fight another day.
You don't like
So
them
then for
together.
me,
Yeah.
huh?
You don't like them together.
No, I do not.
Yeah.
So then it's like, all right, with futures trading, you get leverage through the instrument, not through financial leverage in terms of going borrowing capital in excess of your capital. You just get it from this thing has got a notional exposure to it. So then it's like, okay, how much margin are you committing relative to your capital, which helps you understand the leverage component of it. And then illiquidity, for futures it'd be your the amount of capital you're running relative to the open interest and volume. We don't really have that problem right there, but you don't want to get to where you're so big in the market where
Mm.
now you are the liquidity and you've got a problem. So that's how we
What
apply to futures trading.
what about the complexity? Do you kind of view it as just if it feels too complex to me, that's I'm just putting up a little yellow flag, or do you have actual metrics on that?
Yeah, no, it's more of a qualitative thing. It's thinking about, yeah, how many inputs are used to create it. And that would be more kind of on the quantitative side of things. So something that's more, a model driven strategy than a fundamental strategy. It's like, how many things go in to try to create your model, because the more input you have, then the more, wiggle room you have for mistakes in one of those. And it's just trying to figure out, you know. It's just been in my career, the simpler the strategy and the simpler the model, typically the
Yeah.
better.
So we need to get to HIP, so we're getting there.
Yep.
Um, but before we get there, so the fund of funds model, like during your 19 years, it kind of had a boom and then can we say a bust, right? Like a lot of people soured on it very quickly, or maybe that was just the news. What's your thought on why that model failed, or did
Yeah,
it
I think
fail?
it's twofold, I think. Number one, the multi-strat model really became, I guess the replacement for fund of funds. They
Yeah.
have better capital allocation because they can touch the capital immediately. They have better risk control because they can once again manage it, on an immediate basis. They've got better ability to pull levers in terms of concentration and leverage and all the other things in order to, get great returns. So that that model really, I think, replaced the fund of funds model, all else being equal. And by
Right.
the
Some
way,
investors
they've in
raise
general, huh?
some investors raise their hands. They're like, wait, this fund of fund thing is terribly capital inefficient, right? Essentially,
It
what
can
are we
be,
doing?
but not all, it's just like I don't think you put everything in one bucket. There's
Hmm.
still some great ones out there. One of my ex-partners at Titan has got a great firm that he's kind of evolved. It's called Old Farm Partners. It's a hybrid fund of funds model, but he's done a great job because he's evolved. So I think it's, you just have to figure out how you're going to create value um, whatever model you choose. So I think the multi-strats competed, and then secondarily, after 2008, there were a lot of people who were in fund of funds who then got locked up, and some
Mm.
people wanted their capital back, some people didn't want their capital back, and it just created this bifurcation in interest. And then the consultants, I think, who control the capital for a lot of these investors started to take some of that control back themselves and felt like they could allocate the capital perhaps better than a fund of funds model or make it more direct. And I also think what's happened is the managed account model has come on in force the last 4 or 5 years, where now people you know can kind of create their own multi-strat by doing a bunch of managed accounts. And I think that's also put a lot of pressure on that model. So I think it's a few things that have
Yeah.
kind of done it, but it's not dead. It's still out there, but you just have to figure out how to do it a little bit better.
But nowhere in there did you say that, like, if you put it into Chat GPT, it'd probably say, right, the fund of funds model died because of an extra layer of fees, too expensive. And it
They
seemed
may
like that
say
was in all the
that.
headlines, but
They may say that, but the multi-strats aren't cheap either.
what I was good, that's what's going to be my next thing. They're like just shifted. Like, well, now you don't pay an extra layer of fees, but hey, by the way, you pay their signing bonuses and this and that and everything inside of their performance. So right, I think there was an article, we'll find a link, put it in the show notes, of like the multi-strats are way more expensive. It was like 50% of performance or something.
They are much more expensive, but once again, they've delivered better returns, all else being equal. By the way, I don't want to
Yeah.
make a general comment, but it is an interesting conversation though when it goes to the fee conversation, and the replacement is a multi-strat where, to your point, they're probably a lot more expensive than
Yeah.
a fund of funds.
But maybe that's because of the capital efficiency too. Just it looks more expensive on your cash basis. All right, let's get into HIP. Is it HIP or HIP? We call it HIP.
You know what?
What's it
You call it
stand
whatever
for?
you like, but
Yeah.
I'm kind of hip, so no, I'm just kidding.
Yeah.
You can call it HIP. Yeah. So when I left Titan, I was trying to think about my next endeavor. I wasn't ready to quit. I had too many things in my head I wanted to get out.
Mhm.
COVID hit right thereafter, so I didn't really couldn't do a lot for 2 years because everybody was kind of shut down. But I was kept thinking about this commodity space, and
Back to
commodities
your
that
roots.
have,
Yeah.
yeah, commodities have kind of been in the dumps. As China consumed everything from 2009 to 2010, and what happens then is you get a lot of oversupply because they're trying to meet the demand from China consuming everything, and then things slow, and then you have this oversupply you got to work off over a long period of time. So from 2010 to basically about 2020, commodity markets really weren't that exciting. They went down a lot. We were still kind of working through the overhang of the financial crisis, and then COVID hits, and the economy shuts down, crude goes negative,
Mm.
things you never thought would happen ever. Um, and but a lot of these commodity markets take a very long time to bring on new supply. So when you do have an uptick in demand, now you have the triggers to kind of set for the new cycle, which we'll talk about in just 1 second. But I just kept thinking about the commodity side, and more importantly, commodity managers are different. You know, they like to be in a room with other commodity managers. The multi-strats have been really the spot for a lot of these commodity traders to go. There've been a lot of got out of the market in 2010 to 2020, but the ones that were left are going to the multi-strats. Um, but there's been some challenges in terms of some of the commodity traders being inside multi-strats, and just in terms of the volatility the commodity markets can sometimes express relative to the tight risk management that a lot of these multi-strategy funds have. Once again, they're very different across the board, but in general, I think that's a good generalized comment. Um, So we thought, listen, why don't we start a firm for commodity traders and create a multi-strategy commodity only fund? And I think it actually makes the most sense for commodities relative to every other asset class for these reasons. Number one, in a single commodity market, you have a lack of breadth in terms of how you express a trade. Like
Mm.
for instance, if you want to, usually if you're in oil or gas, you're bullish or you're bearish gas, right? Or oil. And so it's kind of really one trade. And you can do it through a curve or whatever, but you're really thinking this part is going to go up relative to this part. It's a trade. It's expressed through a spread, but it's really a view on one part. Where in a long-term equity portfolio, for instance, you could have 50 names long, 50 names short, and they're all kind of doing different things and get a lot of breadth in that portfolio. You really don't have that in a single strategy commodity market. So breadth is can be a problem for commodities. Number two, scale. A lot of these markets you just can't put a lot of money in. Softs or power or LPG or some of these more nuanced markets. If you're a big allocator and you love to get some money in some of these markets, but your minimum, let's say your minimum investment is $100 million based on the size of your
Yeah.
pension, you have a real problem because you can't be the majority of their assets, right? You probably have some restrictions off of that. Well, if I can put a collection of 10 markets in our portfolio, now I have breadth and I have scale. Where now, if let's say the average capacity of somebody's $150 million, and we have 10 of them, now we have $1.5 billion of capacity or scale in a portfolio where now someone could make an allocation and feel comfortable. And then last is volatility. Because of the lack of breadth, if you get the trade wrong, it can be kind of spicy at times. People say they like volatility until they don't because it hits them in the face.
Yeah.
These commodity markets that we trade are all so non-correlated to each other. We get about a 50% reduction in volatility in our portfolio just because of the breadth in these different markets, which is pretty nice. So we can give an investor in one line item in their portfolio with a lot of different markets that hopefully will give them a great risk-adjusted return profile and give them access to a lot of different things. So that was the goal. Let's start a commodity multi-strat because it makes the most sense in commodities for these reasons, and it actually helps investors probably the most for those reasons as well.
You envisioned it as a commodity replacement? Like instead of your passive 5% or whatever you're doing with XYZ commodity fund, you should come in. This will give you some of that exposure, not directional, but some of that exposure.
Yeah, this is our belief is commodities are actively traded strategies, number one. And the reason why they're actively traded is because of the calendar strip, right?
Hmm.
Because of the shape of the curves that give you either positive roll yield at times or negative. It gives you, you have replacement or competition between commodities at certain times. So supply demand always has to balance. So they are not, in our view, buy and hold strategies. They are actively managed strategies. Okay. And we should be able to, based on the specialists we have, if there's a bull cycle, our traders should be able to see there's a supply demand imbalance, and we're going to be long now because of that. And conversely, they should be able to get short if all of a sudden we've reached a point where we've come to a price point where there is substitution coming in, or there are other alternatives, or people just step away because it's too expensive, and now things have got to reset. We should be able to capture those as well. But if you look at our portfolios right now, predominantly they're predominantly relative value. Most of our guys prefer trading in spreads because it's a more fundamental trade
Hmm.
than just taking a directional bet, which is higher risk, and you got to kind of be right. Where spread, you can kind of be a little bit more fundamental. So our since our since our since the HIP commodity desk launched, it's been about plus or minus 20% net exposure. By the way, we're not targeting that, just what comes out of the wash.
Mm.
Um, in
But different
terms,
than trend following, right? Like, so the first part of what you said, hey, they can catch this when it's going up, they can go short, right? So most people are going to think, oh, manage futures, commodity exposure through trend following. I get that also. So how does it differ? You're saying right now, relative value.
Well, trend following, kind of takes, either a bull trend or a bear trend, but it's usually, they're typically called long-term trend followers. Now, by the way, this is all very simplistic. Obviously, there's great nuances to that as well, where they've employed shorter-term systems on top of longer-term systems that we're trying to manage volatility. But in
We've had them
general,
all on the podcast. They know all those nuances, the listeners. Go
right,
back and listen to episodes 100 and blah blah blah. Sorry, go
do
for it.
that right after this. So anyway,
Yeah.
you have trend following, which is once again just trying to capture the meat of the trade, right? That trend. Our guys can do that, but they also be more tactical and capture things shorter term that happen along the way. So, like for instance, our base metals and precious metals trader is a exchange arbitrage guy, where he's kind of got a core 2 to 3 month view on part of his portfolio where he thinks, a commodity that trades on both exchanges is really mispriced and it's going to have to converge. But then on a much shorter term basis, 1 day to 5 days, he trades short-term volatility in
Mm.
those spreads along the way to kind of help manage that longer term trade that he has in his portfolio. Okay. Some of our more fundamental traders, on the fundamental side, the key is well, their fundamentals are just tell them, this is going to go to this price or to this price. Then it's about timing and sizing of that, right? Because sometimes they're early to those trades because their fundamentals they're so convinced of that the path is really needs to be focused on, and therefore they kind of can get chopped around waiting
Yeah.
for the turn in the marketplace that makes sense. Where a trend
I think you've
follower,
told me before the fundamental guys are usually early, right?
they typically are. It's just been my experience, and they're typically a little bit early, but they're typically right. And the key thing is them kind of managing that being early, so then they can capture the trend that usually comes from behind that. So where will be different? So an index is passive, long only. We are going to be active, long and short through a cycle. We will be, a combination of short term to kind of medium term trades, where some of the index stuff is longer term trades, if it makes sense. From a tax perspective, we're 60/40, they're 60/40. I mean,
Yeah.
it's no
But
real
even in
difference.
terms of your, right, you have the multi-strat ethos of kind of, hey, this is all going to come together and have very low volatility and drawdowns, right? Like it's
Yeah,
that
the whole goal here is we have a
thesis.
lots of ways to win, a lot of different markets, and we have a lot of different ways to manage volatility because of all those different markets. Because once again, what drives softs doesn't drive natural gas. What drives base metals does not drive PJM power. They've got different drivers of returns now. They can have their correlations can cluster at any point in time for whatever reason, but it
Tariffs,
wouldn't be
say.
a
Yeah.
fundamental clustering. It'd be a spurious clustering from time to time. So our job is, let's allocate risk, equally across these traders. Let their opportunity sets dictate whether they want to be more risk on or more risk off. Because as you probably are aware, there's probably 2 to 4 great opportunities in the commodity market in a year. And outside of that, it's a bunch of noise. So you
Yeah.
should probably try sitting on your hands as much as possible, waiting for those great setups. If you have your own standalone commodity fund, it's hard to do that because people are expecting you to put up returns. Within
Yeah.
our portfolio, we actually can encourage someone to say, hey, don't force something that's not there. These other guys are seeing things to do. Wait for your fat pitch, and then when you see it, take it, and I'm sure at that point in time, maybe the other part of the portfolio is reducing the risk because they've realized something in their portfolio. So that's the whole goal is lots of ways to participate in different markets, lots of ways to manage risk, hopefully lots of ways to generate returns in different markets throughout different parts of the year, and gives it in a volatility profile that we think is consumable for institutions.
Talk a little bit about, right, if I'm quote air quotes normal multi-strat. I'm looking for two, three, four sharps or something to all put together. Do you, and you're saying, you've told me offline, you can share it here, right? Some of the guys you get is because they don't fit into that nice picture, which isn't, in our, both of our opinions, a bad thing. They serve a different purpose, but talk how it kind of differs from you guys versus the normal multi-strat and just in terms of the risk controls, the
Yeah.
expectations, all that good stuff.
Yeah, we'll go back to like ground zero. So if you
Yeah.
took a 10.8 Sharpe ratio trader, so below one, and all those different
10
strategies,
individual point 0.8 sharps.
10 individual point 0.8 Sharpe, so
Yeah.
nobody outstanding point 0.8, it's okay. Point 0.8, which is about what a commodity trader is, all else being equal. It's usually about a
Yeah.
point 0.8. But all those markets are minus 0.25 to 0.25 correlate to each other. So basically zero, right? Minus 0.25 to 0.25. You put them together in a portfolio, you can get a 2.8 Sharpe ratio. Okay. So this is where the portfolio effect has a great influence in terms of your overall Sharpe ratio at the very end of the day, in terms of how you can take some things that are below one, but because of their correlation and their different return drivers, you can get actually to an exceptional Sharpe ratio. So we would love to have a Sharpe ratio somewhere between 1.5 and 2.5 with a volatility of somewhere between 8 to 12. Okay.
Yeah.
So we would love to, on a consistent basis, put up mid-teens returns with the opportunity to put up above 20 when the stars align in a few different markets. That's kind of what we would like to do. Now, from a risk standpoint, how do we manage the risk with these traders? Everybody's got a VAR limit in terms of this is the maximum VAR you can run. And it's 3% 95 one day VAR that we use as our measuring stick. Okay. So they can go up until that. Um, most of the traders typically consume 40 to 60% of that VAR. That's kind of their running constant running speed is somewhere in that area, if it makes sense. Then we have levels at which we will review with the trader kind of what's going on in their portfolio. So with down five, we have a conversation with them. Say, hey, what's going on? So you're down five. Um, you know. By the way, this not a surprise to us because we have daily calls with everybody. We have a global call across the board, and we have real-time risk systems in our office where we see live P&L. Everybody gets to see everybody else's P&L, so everybody sees everything. So it's not a surprise. It's not like we wake up one day and they're down five. We're watching it
Yeah.
very closely along the way. So at down five, we'll have a conversation, and then if it continues to go down 10, we expect their risk to be cut by about 50% at that point. And if they continue to go down to 15, we want to be out at that point. The whole purpose here is to live to fight another day. You can come back from those levels. But what we don't want is, someone to get stubborn and hard-headed and really try to fight something that maybe clearly they're either early to, which is the same thing as being wrong, or they're just wrong, or they're sized incorrectly, or there's something else going on that we need to talk through and see what's going on, and then a plan of attack to get back P&L. So
And so those point 0.8 sharps don't make it at other multi-strats. It's not big enough. Who knows?
I think the thing that's in my experience, what has influenced the commodity guys at Multi-Strats while they get fired is um, big drawdowns. They were given a lot of money and they were encouraged to take a lot of risk, and it didn't work out and they had a big drawdown and they blew through their limits and they were let go. And
But to your
sometimes it's
point, they like were forced to take risk. Like I'm not seeing anything in this right now. I'm like, well, we need you to have this
I'm going to
much
use
on.
a different word. I'm going to say
Sure.
encouraged to take risk.
Yes. Yes.
I'll let you use force, but they were
Forced.
encouraged to keep risk at a high level. And listen, from the multi-strats perspective, when you've got,
It makes sense. Yeah.
$25 billion and, 150 traders, I mean, you can absorb, a lot of noise, and you just want people to have risk on because it kind of comes out in the wash for them at some point. But they do have a level at which most of them say, enough. And sometimes it's a number. It can move around. It can move around to some extent, and sometimes it's the path. So sometimes it's the path of returns being too volatile versus just the absolute number being negative. So,
Yeah.
if you see a lot of volatility in the P&L path, sometimes that can influence their decision in terms of if they want to stay with it or not. So there's just so many different things. But from my perspective, um,
And to me, real quick, while you're thinking of that, like the trend following sort of inside the portfolio exhibits the same thing, right? You're in this silver loses 10 times in a row, stopped out over like 9 years. Why would anyone keep that in the portfolio? And then the 11th year, it makes 50x or whatever on its when silver makes a run. So, similar thing of like maybe they need, in this case, weeks or months instead of years, but still too long for the normal multi-strat to endure, right? They want the profits now.
yeah, it's hard. Listen, we're all learning the performance game, and it's hard to be patient sometimes. Very
Yeah.
hard. I mean, we all have behavioral biases. We all have, pressures from investors and things that we have to do in order to hit our goals. They're just like the rest of us. So I think that what we just want to do at HIP is have a culture where we can let these things breathe enough with live to fight another day still being the thing we have on our wall, right?
Yeah. Yeah.
So we have to let them breathe, but we can let them breathe within a portfolio of a lot of different strategies so that one shouldn't, dictate what's going on with the rest of the portfolio. So we limit the amount of risk any one strategy can have so it can't submarine everything else. And then you hopefully let the opportunity set, the experience of the traders, the risk management oversight that we have, and the diversification of the portfolio now help once again limit the downside, hopefully, and skew the upside is obviously the goal. Is trying to keep that profile.
And then you guys also do a little bit something different in how you incent these guys, right?
Yeah, this is the other big thing about our firm that's different that a lot of traders have been interested in. So Jim Simon said it best. He said, if you want to create a great firm, this is a secret. You hire great people, you have a great infrastructure, you collaborate, and you
Mhm.
share the profits. Okay? So we're hopefully trying to do the first two. Now collaboration and sharing. What did we do in order to um, help that. Number one, collaboration. A lot of people talk about, yeah, we want our people to collaborate. Well, how do you get people to collaborate if there's no incentive to do it? Charlie
Yeah.
Munger said it best. You show me the incentives, I'll show you the outcome. So the way we've done it is we're not a pod shop. Everybody that's a trader comes as a partner. Uh, so it's a pass-through model, but every trader earns 20%. 15 of that 20 they get that is not netted against anybody in the firm. So it's what they kill, they eat. 5% goes to the house. They're a partner in the house. So why would you want to collaborate with the other nine traders in the room if there was no financial incentive? Well, there is now because now you have a piece of their P&L, they have a piece of your P&L. So if
Mhm.
you see something in their market, if they see something in your market, if there's something that overlaps, you know, we should be talking. And we have a call every day, a global call to go over all the markets together. By the way, this is what happened at Refco. Willard would lead this meeting back at Refco. So I think it started at 7:30 in the morning with our meteorologists and went through every market. It's kind of what we do here. We go
Should
through
call it
every
the Sparks
market.
call. The Spark call.
Huh?
You should call it the
Yeah.
Spark call. The 10 a.m. Spark
We
call.
should call it the Spark call.
Did
But we
anyone
go through every
debate that and be
market.
like, we need the call before the market's open, or can we do it after lunch? Was there debate on the time?
Oh yeah, oh yeah, and it's probably going to move around some more. Yeah, because it's never perfect for everybody at a certain time in a certain place, but we decided on this time. My gut's telling me it's probably gonna go a lot earlier, but we have calls with individual team members usually before that call to kind of go over markets as well. But the whole purpose is get everybody talking and hearing what's going on in their market. It'll trigger a thought, it'll trigger a conversation, but we force that collaboration through the call, and then want them talking obviously with each other afterwards as people that are part of the same team, financially incentivized as well. So the collaboration and sharing are tied to each other through the incentive structure that we think helps. And you know what? I think at the end of the day, a lot of our traders have been in the business for 20 years, and at this point in their career they want to build something, they want to build something together, and they want to work with a group of people where they can build something together, and once again not be isolated by themselves trying to figure out everything, because it's hard, right? If you're in a room with other people, then it's got a different energy to it, it's got a different flow to it, it's just got a different atmosphere, and it's resonated.
How do you guard against like groupthink? Because they're not trading the same things anyway. So even if they all have the same idea, it's not going to exhibit itself the same.
It's exactly right. So we have one crude trader. We don't have five. We have one gas trader right now. We don't have five. The fear is, yeah, if you get five gas traders and one's got the hot hand and all the fundamentals are pretty obvious, then you just have one big gas bet on rather than a bunch of
Yeah, yeah.
diversified gas bets on. So if we were able to find another trader within a market, we'd really want something with a different approach that gives us diversification of approach versus just that. So if we had a fundamental guy and we had a quantamental guy or a quantitative strategy that we thought was different and complementary, that would be interesting, right? Be very, very interesting. But having two fundamental crew traders, I mean,
Yeah.
I don't
And
think
but
that
if you
makes a lot
found
of
it's
sense.
more so of like, oh, you should check the volatility on that option spread or something like I just saw it spike in my corn. You should check it in oil or right. It's more comments like that of like, here's what I saw in my space. Make sure you're looking at it in your space.
Yeah, or that, or even like LPG. It was pretty interesting. So about a week or so ago, our LPG guy was like, "Listen, I'm hearing out of the Middle
What's
East there's
LPG
all
for my friend George?
it's liquid petroleum gas. So just think propane.
Yeah,
So there
yeah.
are a bunch of associated gases that come from crude oil production, natural gas production, and it's butane and propane and all these other gases. And by the way, we don't drill for that stuff. We just get it from
Yeah.
from fracking. Um, so in the United States, it's a huge producer. Middle East is a huge producer, obviously because of their production over there. But our LPG guy was talking about what he was hearing was maybe a lot more production of LPG, which by the way comes from crude production over there, right? Once again, associated gas. And he was like, I don't know if you guys are hearing this as well on the crude team, but y'all should probably look into this to figure out
Mm,
what you're seeing in terms of your balances in terms of the Middle East, which is pretty interesting. The other thing the LPG guy said was, I mean, this guy's been in the markets for 25 years, and and demand has been pretty soft in LPG in general. It's used to make plastics. And he's like, when it's this soft, and I've seen it this soft historically, it usually tells me we got a wobble coming in the economy because it's such an important petrochemical. It's a feedstock to so many things. And you know what? It's like, okay, that's an interesting kind of macro thing to keep in the back of your head because obviously petroleum and a lot of stuff is tied to GDP growth and demand and things of that nature. So it's just, you just hear comments like that in the room and you just kind of, sometimes I'll stop the conversation and say, everybody just file that in the back of your head. It may not
yeah.
immediately apply to what you're doing, but just don't forget what that comment was because it may be important to you at some point along the way. So those conversations bring up interesting things like that from a group of people that have been doing it for a while that I
Right.
think
Like literally some of
helps.
the smartest commodity people in the world.
Yeah, I mean they've been at really notable places. So and been very successful at those places. So it's great to hear the comments.
And what's happening, like the Glencores and big commodity houses of the world, the banks, they're all sort of getting out of commodity trading, or it's been on a downtrend over the last 10 years?
Yeah, it seems like the banks in general. I mean, I guess two banks in particular are getting out. I don't want to name who they are, but they've kind of pulled back. I think the Russia-Ukraine war and what happened on the LME really hurt some folks, and I think that really lessened the appetite for a few banks in terms of their exposure to the space. Um, Listen, I think the Glencores, the Traffies, the Vitals, the Mercurias, I don't think they're getting out of the business anytime soon. They obviously had banner years, 2020 through 2023 probably. The last year and a half or so have not been that great. I think the tariff noise this year caused a lot of problems, just because a reciprocal tariff would have normally been they tariff us 10%, we're going to tariff them 10% as a reciprocal. But when you start to look at our trade imbalances, what the measuring stick is,
Yeah,
nobody knew what that meant. But boy, its impact on markets was pretty dramatic, pretty darn quickly. Um, and I think, as you know, in commodity markets, you've been doing this long enough. Usually, when you have things like that, they matter a lot the first time, and then they matter less the
less
second
and
time, and
less.
they matter less the third time, and then it resolves itself, and you get to more fundamental markets. I hope we're past
The
most of
noise.
this, and now it's going to be a little less so and get a little bit better as people now can kind of get their heads around what all this means.
And then how do you get these guys? You got to throw them $30 million signing bonuses, or is it getting to like
We give $100
NFL?
million bonuses at our place, so that's how
It's,
we get them.
it's like
No, I
NIL
wish.
system in college sports or what, right? Like, because you read some of these
Uh,
stuffs of these large traders moving around between the multi-strats, and the numbers are staggering. So, right,
yeah,
props to
no,
you for being brave enough to be like, oh, I'm going to get into this business and figure out how to sign these guys.
yeah, I should have thought more about that before I did, because it is difficult. I mean, it's very difficult. It's very competitive out there. There's only a small group of commodity traders, number one. We've lost some to some firms because of the big bonuses that they're able to sign to begin with. Um, and
You
that's
tell them you'll
fine.
be
I
back.
mean,
You'll be back once they net you out, and yeah.
listen, it's fine. They've everybody's got to do what they think is best for them. But I think our value proposition is pretty clear. It's pretty distinct. Yeah, okay, I can't give you the big signing bonus up front. I'm sorry. But if you want to be a part of a collaborative team where we're all working together to bring a very unique product to the marketplace, which is a commodity only multi-strat, which there really aren't any of. I mean, when I say aren't any, there's less than a handful in the
Yeah.
marketplace of a product like this. So if you want to come here, be with other commodity traders, work to build a firm by being a partner, start with less and hopefully build with more over time. This is a great spot for you. We know commodities. We've got risk systems that understand commodities. We have a great investor base right now. We think that we're only limited by the capacity of our underlying traders and the opportunity set in the marketplace. Can't do anything about the opportunities in the marketplace, but those come and go. But now it's just about getting really, really talented traders that want to be a part of this. And we're getting a lot of traction and interaction with people we shouldn't be because we
Yeah.
don't have the $100 million check to write somebody up front. But they
Mhm.
love everything else, the rest of the
Right.
story. They love it.
How many do you have now, and how many is your ideal?
We have seven now: crude oil, LPG, PJM electricity, natural gas, refined products, softs, and base and precious metals. What we would like to have over the next 3 months, and we're in detailed conversations with folks, grains and oilseeds.
Hmm.
So, you know, getting someone in those markets, we don't have right now. We've got a few different people that we're looking at really different approaches in that market. We don't have European power or gas, and we're talking to a few folks in that region that would give us exposure to that. And then in the United States, we have PJM Power. We'd like to get ERCOT, which is Texas, and we'd like to get the West, which is Washington State down in California, as part of that. I mean,
No, Reggie. What's
everybody's
the East
read,
called? Reggie.
huh?
What's the East Coast is called Reggie, or is that
Reggie is part of that PJM kind of
okay?
corridor as
Got it.
well. That's kind of more on the carbon side of things. We'd like to get an environmental credit trader.
Mm.
Obviously, they impact all these markets, and I think there'll be really interesting opportunities there. The power side of things, we've all heard the stories. I mean, the amount of money we're going to invest in infrastructure and in power generation to meet just the data center demand is pretty profound. Um, AI eats, data centers eat commodities, infrastructure eats commodities, electrification eats commodities. If you are a big believer in that thematic, that narrative, that secular driver, that's, by the way, government sponsored. I mean, we've got the government buying public companies that are in rare earth metals and things of this nature now. It's kind of interesting. So you've got, government sponsorship for a lot of this stuff. At a point in time, our you just can't create a new copper mine quickly. A new copper mine takes 16 years or so to make. And so if you have a really big
And they
demand
haven't made one
push,
in about 16 years. Yeah.
huh?
And they haven't made one in about 16 years.
Yeah, it's a bottleneck for sure, and it's concentrated in a few regions around the world. So you have supply chain potential issues there. You've got protectionism that could jump in. You've got all kinds of things that could really affect these markets. If you look at natural gas, which is the base load kind of energy to kind of help get us to if nuclear is an answer or whatever it's going to be, it's not going to go anywhere anytime soon. We're not going to get off of crude oil anytime soon as well. And we haven't done a lot of exploration in the deep water stuff or the stuff that's more durable versus fracking, which has got really high depletion rates. And you always have to, keep once again looking for that stuff. If you look at the grain markets, I mean, they're the cheapest levels they've been. I mean, land prices, fertilizer prices, fuel prices, labor costs, all through the moon, and we got grain prices way down here, right? Um,
Maybe
Very
they'll save
interesting.
the rainforest.
Maybe, but I mean, you just have a collection of things across energy, across ags, and across metals that are very interesting right now, and all of them have different cyclical drivers that once again help create a balanced portfolio within the commodity space.
Love it. No meats. A meats guy.
Love to have some meats, I feel like I'm going to do Arby's. We have the meats,
Yeah,
right? We want to
yeah.
we want to have the meats here
We want
at
to
HIP
have the
as
meats.
well. Huh?
And I'm looking at those trees behind you. You need some lumber too.
Do they? Yeah, I guess we could do some lumber. Listen,
But how
we've looked at palm oil, we looked at milk, we've looked at some other really nuanced, really interesting markets. The key thing is, do we have enough liquidity to trade those markets, and can they generate some interesting P&L? We don't need people that generate $250 million of P&L in their strategy, but we want a collection of traders that could do 25 to 50
Hmm.
in their markets, and you put 10 of those together. Now you've got, once again, a lot of ways to kind of get to an interesting rate of return without depending on one to drive the whole thing and be right. So that's the whole goal here is, and like any portfolio, like at Titan, when we had our fund of funds portfolio, if we had 20 managers in the fund, there's probably six that drove returns in any one year, and then there's probably seven or eight that were kind of middle of the road, and then you had a few that were underperforming or losers. But that's kind of the way it's going to be here, the way I anticipated that you'll have 60% kind of drive the performance. You'll have hopefully 20 or 30% that are kind of middling, and then a couple of people that are maybe down on the year, and that'll get you to an interesting rate of return. That's kind of hopefully how it'll work out.
And then do you think this is a good complement to an institution? And I've got a equity basically based multi-strat, or I've got a, what do we call them? A traditional multi-strat to be like, hey,
Man,
you already know about multi-strat. This is a great tack on.
how this is the I mean, we can go on this for hours and I can get so excited about this conversation. Number one, commodities are woefully underallocated by institutions right now. Okay. Typically they've been between 10 and 15%. Right now, I think they're hovering around 5% in terms of their allocation. I believe that's because there's not a lot of options for what they do and how they can allocate. There's some passive indices, but I don't think they're great active management strategies for what they do. I don't believe. It's my bias, so I'm gonna stick with that. So I think they're woefully underallocated. Number one in terms of what they do for a portfolio. I mean, history has shown and research has shown they are non-correlated to stocks and bonds. So they're naturally going to give you a great portfolio benefit, particularly if you're a big believer in stagflation or inflation or de-dollarization or any of this stuff that really could affect, bonds in particular. Commodities do usually do exceptionally well in that period of time. So if you got a 60-40 portfolio, that 40 may have some noise in it because of all this stuff, where commodities would probably really shine from that. So I'm a big believer you can't eat non-correlation, right? You got
Mhm.
to have positive returns. I think we have offensively, we have great opportunities. Data centers, AI, deglobalization, all the things that we've talked about are offensive ways through commodities you can capture that. Defensively, if you're worried about inflation, commodities are a great thing. You get for free the non-correlation. That's free.
Yeah.
You're going to
Yeah.
get that no matter what. But hopefully we're going to get return from this,
Mm.
and that you're just going to get a natural benefit from it at a point in time that I think it demands a hard look, and it's woefully underallocated.
That I like that because most people are selling the thing on the other side. They're selling the non-correlation and ignoring those pieces.
No, you have to.
Yeah.
I mean, listen, we all have to make returns. You have to.
Yeah.
So, what is it you're going to make returns off of? These things provide the opportunity, right? And by the way, we don't need a market to go up. We just need volatility. Commodities are trading vehicles.
You
They
just
need
need interest in
volatility.
those things. Yeah.
Huh?
You just need interest in those things to be like, it's a huge run up, it's a huge sell off, nobody wants it, it's back.
Yeah, we just need movement in the commodity is where we can make money throughout the cycle is by having the volatility. As a matter of fact, McKinsey wrote a report uh, probably about a year or so ago and just talked about how commodities usually do very well in high volatility periods. And by the way, from my experience at my days at Titan, equities do terribly in high volatility periods typically, and commodities have done better. And I was just reading something today actually that I think somebody from Bloomberg had put out. But a lot of people don't want to invest in commodities, particularly if they think we're going to recession because they think commodities are going to be affected. Actually, the research shows the opposite. Actually, commodities go up during a recession because they usually have gone down prior to the
Already.
recession.
Yeah.
And then when the recession hits, they're actually going up while everything else is still going down. So it's
Mm.
actually a really interesting dynamic where, commodities actually can be that really, unique thing in the portfolio in a recession that can do well when other things may not be doing so well.
Any other thoughts? We've covered a lot. What else you
No,
got?
listen. I mean, I'm super passionate about the space. I think that the next 10 to 15 years are going to be some of the most interesting of my career. I think that we just have a lot of things we have to resolve in the world. Commodities are at the center of a lot of that. I think this deglobalization trend that we have is an underlying, thematic that affects commodities greatly. And then when you add all the other things on top of that, I think there's gonna be that volatility environment to be able to trade underneath a very interesting fundamental backdrop to be able to capture opportunities. So
Any
I'm
thoughts? Just as you
uh,
mentioned, deglobalization, my brain went to each region will have their own commodity exchange, their own, which they already sort of do, but it might grow. You might get more liquidity in each region if that happens.
You might, and the biggest one right now, which is a problem, is the Sheffield exchange, which is in China, and it creates a lot of difficulty because if sending money to a Chinese exchange, right? Um, but outside of that, yeah, listen, I think that commodities should continue to grow here. They're cheap as they've ever been relative to equities, ever,
Hmm.
which is really interesting. If you look at
Although
like
it
the
might be
Dow,
saying more about equities. Yeah.
well, it is more of an equity story for sure.
Yeah.
Where commodities have been kind of left for dead as equities continue to go up, but those things typically resolve themselves. So 1970s they resolved themselves when equities came down, but commodities went up as through gold and through oil. From 1999 through 2009, 10, equities were dead flat. Commodities
Yeah.
were up 300% at the top during that period of time. As once again, China was consuming everything. And I'm not making a call on equities. I mean, I have no earthly idea if they're going to continue to go up or not. But I do know that there are so many forces underlying this commodity opportunity that, once again, I'll say it again, it demands attention because I
I
don't
like
think
that.
people are paying attention. It demands attention.
That's a good one to close it out on. Demands your attention.
Demands
Um,
it.
all right, Tom. Thanks so much for coming on. Best of luck with everything.
I appreciate it. Thanks so much, RCM, for your time. And let me get my story out. I really appreciate it.
Yeah, we'll talk to you soon.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.